Ladies and gentlemen, welcome to a new session of Room for Discussion. Today we'll talk about the Eurozone. It's still ongoing. We can consider it almost to be a constant. Every day you open a newspaper and it's on the front page. Today, we're honored to receive a very prominent guest, Mr. Kounis. He's the head of the Macro Research Department of ABN Amro. Today, the European Commission will present 3 possible solutions. It leaked out yesterday in the Financial Times. We hope we can discuss that with him as well. He's on top of the market, so if you have any questions, feel free to ask him and make use of his expertise. Give him a warm applause.
Yeah, welcome, Mr. Kounis. As Vincent said, we're very honored to have you here at Room for Discussion. You're the head macro research at ABN Amro. What is your job description exactly?
Well, I'm responsible for putting together the outlook for the global economy and what that means for interest rates and exchange rates.
So does that mean you sit behind computers like all day long, or?
Well, sometimes there's some spreadsheet work, but actually mostly I'm visiting clients and doing presentations at seminars, presentations in meetings, and so there's a lot of presenting as well as analysis, writing, number crunching. So it's a variety of things.
Yeah, and you were born in London, right? And both your parents are from Cyprus.
Yes.
Is that right? What part of Cyprus?
Well, it's complicated. My father was actually born in Egypt, but he's Greek Cypriot from Egypt, if that makes any sense.
Greek Cypriot from Egypt.
Yeah. And my mother was born in Cyprus. They're both from originally going back from a place called Paphos, which is a kind of a place in the western part of Cyprus. Well, Cyprus is very small, but it's on the west.
Okay.
Yeah.
So we can say you have at least in some part some Greek roots, very far.
Yeah, for sure. And actually, I do speak Greek, not incredibly well. We're not going to switch to Greek now.
No.
But I can speak it, and I'm proud of my Greek roots. But because when you're born, I was born in London. I was raised in London. Then, I also feel like a Londoner, really.
Yeah, like an Englishman.
Yeah.
But you speak Greek. That's very nice.
Yeah.
That's a nice bridge to the Greek situation right now. We read your columns. You write a column in het Financiële Dagblad, or not a column, but we could see you coming back in the Financiële Dagblad a lot. And in early September, you wrote something in an interview with the Financiële Dagblad that you admire Papandreou.
Yeah.
Has that admiration changed since then?
Well, I think I think his recent action with the referendum was probably not the smartest thing to do. But he's someone who was in an incredibly difficult situation, of course. And the country started off when he took over. It appeared they found new debts, and actually even today I would say that they're finding new debts. So the economy was in a dire straits, and so I think in that context, he kept Greece more or less on the IMF program, and it's been, of course, a very bad time, but it could have been much worse up until now.
But you say the referendum was a stupid thing to do.
Well, I think that he was frustrated, actually, that basically he felt, I think, like a guy who was the one man in Greece saying, let's follow the IMF program. And everyone was saying, no, don't follow the IMF program, you're crazy, you're taking us along a bad route. And then I think he probably wanted to say, well, okay, what's your alternative? What do you want to do? Do you want to stick with the program and stay in the euro, or do you want to actually face the abyss? I think the way he did it was, of course, extremely irresponsible. But I think that was where that impulse probably came from.
So right now, what do you think of Papademos? Will he be a better leader?
I don't really know too much about him. I've seen him. I follow the ECB press conferences, and he was always the guy sitting next to ECB President Trichet.
Yeah.
But he was not really saying too much. I know that
he's nodding well.
He was nodding, yeah. Sometimes he'd get a question on Greece and, he'd say a few words. But, I mean, he's clearly a technical economist with a lot of standing. He studied, I think, in the US. He has a PhD. He's, got incredible experience around the place. But, he's what they call a technocrat rather than a politician. And, sometimes you wonder whether a technocrat is just not going to get swallowed up in this heated up political environment.
Because you have some Greek roots, and we talk a lot about Greece, and we miss a bit the perspective from within Greece. And I'm wondering, what's your vision on it? Will the society be able to bear the austerity measures and the programs? Will they go with it? And how far can the Greeks go? I mean, you also know the Greek culture a bit, I hope. Mm-hmm. Can you say something about that?
Well, I was in Greece recently speaking at a conference. So I spoke to a lot of taxi drivers and also some people I know there, some family and some colleagues at ABN Amro in Athens. And, I do have a feeling that everyone is incredibly frustrated. I don't know whether everyone is really in agreement with the path the IMF and Europe and the Greek government has been taking. It's difficult really to get people really to be enthusiastic about incredible spending cuts, So I think, you can understand the frustration. At the same time, I think sometimes the amount of protests in Greece are exaggerated. I mean, I was watching once a CNN report where they were saying, there's incredible protests in Greece, and there was a place called Syntagma Square, where actually there was 2 lines of people protesting, and they were like acting as if the whole of Athens was on fire. But
it's also the scope of the media, which exaggerates sometimes.
Sure, yeah.
So you have some faith in that they will overcome this drastic situation in which they're in right now?
Well, I think that it's going to be very difficult. I mean, I think they probably will need to have further debt reductions, debt write-downs, because at the moment their debt path is still looks unsustainable, and it's going to be very difficult to get it back to sustainability. And I think they're doing the right thing by following the structural reforms in the IMF program. That's essential to remain in the euro. But over the next 2 or 3 years, these are not going to really bring them any gains. The only thing they're going to see is pain. But if they follow the path, then in say 5 to 10 years, the economy can be restructured, and then the future will once again be a bit brighter.
So more long-term hope. Let's say that.
Exactly, yeah.
If we shift to the west, to Spain, yesterday Mariano Rajoy, I think I need to pronounce it like that, he was voted into power. Of Rajoy, I don't know the Spanish, I think they pronounce the G as a G.
Don't ask me.
Excuse me, correct me if I'm wrong. He's a right-winger, he's a conservative. You can see a change in leadership there as well. I don't really know the Spanish problems, but what problems is he facing? What specific problems are there in Spain for him to tackle?
Well, let's start a little bit with some of the advantages Spain has. I mean, the big advantage that Spain has compared to other peripheral countries is that it has a low level of sovereign debt, which I think is important. On the other hand, it has still a relatively large budget deficit, which needs to be brought down. And like Greece, like Portugal, like Italy, it has serious problems with its economic structure, which so it needs to reform to become sustainable within the Eurozone. So his challenges are really to try and have a good balance between austerity on the one hand, reform on the other. But it's going to be very difficult. I'm not a believer in the idea that these economies, whether it's Spain or Italy, can just come up with a whole load of spending cuts, and then markets will think, okay, great, you're okay now, we'll finance you.
Yeah.
I think that that's really, basically, well, at the very least, wishful thinking.
Yeah.
I think, we have a systemic problem in Europe now. Basically, if you look at the demand for government bonds, especially peripheral government bonds, it's essentially not there anymore. Commercial banks don't want to hold peripheral bonds. Insurance companies don't want to hold peripheral bonds. Pension funds don't want to hold them. They've spent the last year trying to dump their peripheral government bonds. Of course, these countries still need financing. The question is, why will they come back quickly into peripheral bonds? And, it's not going to be because they announce lots and lots of austerity during a deep recession, which will probably be self-defeating. It will be because we get systemic or system-level solutions at the European level. And that's where I think that Germany and others really need to take a lead in doing that, rather than saying, okay, don't worry, you can sort it all out yourself by just announcing more and more cuts. It's basically whatever problem Europe has, the answer is cuts. It's self-defeating. It hits growth, it hits tax revenues. It means that your deficit actually widens, and then you're told, more cuts. It's.
Well, we come to the systemic problems later, but we can see a transformation in leadership in those countries. So it's the return of the technocrats, and they lack some sort of democratic mandate because they were being installed into place. In Italy, Mario Monti, for example, his government consists of like 7 scientists. That's quite a lot. Do you think that will cause problems, that lack of democratic mandate?
Well, my personal view is that there has been, and I guess a lot of people think that there's a democratic deficit in Europe, which has now come back to haunt it. There is a kind of approach that, okay, let's just continue with this democratic deficit and try to continue without asking the people anything. Again, I mean, personally, I'm actually a big pro-European, but I think that Europe needs to be sold to people, and there needs to be a discussion about Europe with the public, rather than saying, okay, don't worry, just forget about it. We continue, because you do need a democratic mandate to move forward.
But right now, solutions need to be made. If we would talk with people, would cost time. Isn't it good right now to just have people make the decisions and go through depth, and then when we get better, maybe get some new politicians or Democrats?
Well, yeah. I mean, time is of course an issue, but I think you will need a democratic mandate eventually. I mean, I'm not saying that the best thing for the sovereign debt crisis right now would be to have loads of elections and loads of uncertainty. But the point is that we've seen that if you're going to take a country through an incredible path of reform, or if you're going to argue that we need more fiscal union, you need to have public support.
Yeah.
And I think that there is a very strong case to make for Europe, but it's just there is no one making it.
No.
What will be the right ratio between Democrats and technocrats right now? Because there need to be decisions made, but people also need to be involved. How would it look like? Or?
Well, I think. Well, I mean, it's. I would not say necessarily that if you have a technocrat in charge, then there is no democracy. I mean, obviously, these guys are being supported by political parties which have been elected. I think that there's nothing wrong with technocrats per se, but the only thing you wonder is whether a technocrat is the right person to, maybe they will find it difficult to get the political support to get legislation through, whereas a politician, is maybe a bit more streetwise. And, of course, governments are full of technocrats. I mean, it's not as if, there's the only economist in the building or something. I mean,
but we're just wondering, is it not maybe an opportunity now in the short term that finally some reforms which should be made are being pushed through? Don't you see some kind of opportunity in that?
Yes, of course. I mean,
so it could be a blessing as well.
Absolutely. I mean, this debt crisis, if there is any blessings with having a debt crisis, a recession, an existential crisis for the Eurozone, then it's a big opportunity, I think, for change. Structural reforms in these countries, a degree of austerity, of course, but also I think movements on the European level towards fiscal union, which I believe is necessary to support the monetary union over the long term.
Yeah, well, that gives us a nice bridge to, I think it's probably presented right now in the European Commission. It was leaked yesterday in the Financial Times. And under the lead of Barroso, I think, the European Commission came with 3 solutions. Namely, let me have a look. The austerity supervision, like a watchdog, more supervision on the national budgets, full Eurobonds or blended Eurobonds. For me, the blended Eurobonds was something new. Maybe you could explain to the audience a bit about the blended Eurobonds, because I don't think a lot of people know what that means.
Well, just to sort of start maybe at the beginning, because that's, I think, maybe helpful. I mean, the first option is just to have complete Eurobonds across all countries, which are jointly guaranteed, which means that every country guarantees each other's debt. The second option is to only do it partially, up to a certain level of debt. Say, arbitrarily, maybe like 60% of GDP of debt will be Eurobonds, and then the rest national bonds. But again, jointly guaranteed for that part, which is Eurobonds, or they call it now stability bonds.
Okay.
Then the third option is that it's not jointly guaranteed, but each country basically guarantees their own share of the debt, which is a much weaker form of Eurobonds, because essentially, and that's what the sovereign debt rating agencies have said, is that under a system where each country guarantees their own bit, the rating of those new bonds will be the lowest common denominator, which, if Greece is involved, that's pretty low. That's close to default type rating. So, that's a problem there, and that goes to show that that basically you really need, I think, jointly guaranteed bonds to really solve, not solve, but to have a credible, a credible financing mechanism.
Don't you lose the incentive then, the incentive mechanism for profligate countries, to get their budget right? And I mean, if you have up to 60%, then the rest still has that incentive thing coupled to it. So don't you think, to me as an academic, when I read about the blended Eurobonds, for me it was like heaven. Wow, this tackles every problem.
Oh, that's the option 2, basically, up to a certain,
Up to 60%, so then you get like a big pool of all the European debt. It's, I think, $7,000 billion. If you compare that to the US, it's $7,400 billion. And we have a lower rate of debt to GDP. So that would mean, I think, a lower interest rate, even than the US. And then you still have that additional amount, which makes sure that, for example, Greece has to pay a larger yield on their extra debt. So that will hurt them. So they will have the incentive to get a nice, sustainable budget. But is that like an academic thing? And is it not? Can we not see it in the real world? Or what's the weaknesses?
I think we need to wait for the full detail of exactly what they're proposing, because the documents. I mean, I've seen documents, but they're sort of leaked. So basically, one of the issues with that is, I mean, Greece has a debt of heading to 180% of GDP. So basically, you're saying, okay, 60% of that will be financed, and then Greece will have 120% of GDP which is not financed. And then you have to think about how will it work with the flow of new issuance. Will it be that the flow of new issuance will be completely guaranteed, or will it be that only, if you have a debt above 60% of GDP, then your new issuance will no longer be guaranteed? Because if your new issuance is not guaranteed, essentially you don't solve the problem at all, because the problem that all these countries have is that they can't finance themselves.
Yeah.
I guess it depends exactly how it's structured. But I think there are other ways to ensure that Eurobonds are a system of control rather than a blank check. And one system that I quite like is just the idea that you have a central body which says, okay, say Italy's deficit has to be 3% of GDP next year. It has redemptions of another X% of GDP. We issue centrally for Italy, and then Italy gets enough to finance its deficit target, which is set centrally, plus its redemptions on its old debt. And then basically you make issuance by the country itself in terms of non-Eurobond issuance completely unattractive, so that you really force it to only get finance from Europe, and you only give it enough finance to meet a deficit target which you've set. So in essence, they have to spend a certain amount because that's the only amount they get. So I think that, Eurobonds in that sense can be an instrument of control rather than just a blank check.
But do you foresee that Germany will ever agree upon this integrated solution?
Yes, eventually. They're not there yet, but the thing is, Germany, and I think the same is true for other Northern European countries like the Netherlands. Essentially they have three options. One is to stand aside and do nothing, and I think then you have a big risk that the Eurozone will fall apart, and that will be a complete and utter economic catastrophe. The second option is to say, okay, let's let the ECB, basically start printing money and buying up everything. And I think that if you think that that's a good way to actually sustain a monetary union, I think I think there's big question marks about that.
In terms of inflation that's caused then?
Inflation in terms of incentives, because you just buy government bonds at random in the market using printed money.
Because the market is asking for it. You read it a lot.
Yeah.
Get that printing machine working there. But you see it very damaging.
I think in an indiscriminate, unlimited way, then it will be very damaging. It's basically you don't have to look too hard to find instances of deficit or debt, monetization of debt in the history, which has, maybe not next year or the year after, but eventually has caused inflationary problems, which has caused credibility problems for governments, because essentially people are not going to want to buy government bonds which are where the deficit is financed by printed money. I'm not saying the ECB can't be part of the solution, but it cannot be that the ECB says, okay, we are the unlimited source of printed cash, and then you think, okay, that's a great foundation for a monetary union. To me, that's crazy.
Should they do more in the short term now, more than they are doing right now?
Well, I think the ECB has basically an opportunity here, which they probably should have used a few months ago, to say to governments, look, we will step in and do more if you set up a clear framework with concrete steps and a timetable towards fiscal union. If you do that, then we're willing to be the bridge, a financing bridge, but we're not willing to be a financing bridge to nowhere. There has to be a sustainable end game which puts Europe on a stronger footing. I think for the ECB to get involved in this in a big way. So I think the ECB has a role to play, but you need a long-term foundation and a long-term framework to underpin the
So it should
the
be
ECB's
coupled
action.
with some long-term systematic fix.
Absolutely.
Then they can do something. And
Exactly,
maybe relieve
yeah.
some pressure.
All right.
If we economic students, we follow the Euro crisis, of course. We study economics. We think it's very interesting. You, as a head of the macroeconomic research, what indicators should we follow close? I mean, there's a lot of stuff happening. Where should we shift our focus to? What are the interesting parameters? What are the interesting events?
Well, I mean, from a day-to-day perspective, we look at a lot, of course, at the bond yields of the countries concerned. We look at the auctions of these countries, because what's very important is whether they have a financing problem. For instance, this morning, Spain issued 3-month bills. So these are just 3-month loans from the market at 5.11%, which is an extraordinary level, and is really suggestive of it having financing problems. So we watch the financing side well, also market indicators of banks, because of course a big way this whole thing works through to the economy is because banks have big exposures to peripheral governments, to peripheral consumers, peripheral businesses, and so we watch these indicators, these so-called CDSs of banks,
Credit default swaps.
exactly, which are kind of insurance on bank debt going bust, essentially. That's been rising again, and some other. Don't want to have too long a list, but we also look at deposits of banks, especially peripheral countries. Are people in these countries taking deposits out of the banks? Because that would also be a very negative
Do you see
sign.
that happening in any of these countries?
Well, Greece, we've seen it already in a big way. The other countries, not yet, but we don't have the most recent data. So that's something we're monitoring. But that's something which could put banks in difficulties, especially there. But essentially, throughout Europe, I mean, banks have to refinance a lot of debt next year. And at the moment, they are also experiencing funding stress. So, we are getting to a point where, we really need to start coming up with, bold solutions, or we're going to have financing problems in countries, financing problems in banks. That means that financing conditions for the economy will tighten, so-called credit crunch. And I mean, we already expect a recession, whatever happens, but the question is how deep and how long.
And we need liquidity now.
Absolutely, yeah.
We were looking at you were telling about all the hard numbers as indicators that you're looking at. At the same time, it's almost like a soap, people, they're all stressed out about what's happening and they lose their confidence, or political leaders change, like Berlusconi or Papandreou. How do you take these political events in account in your analysis of the economy? They seem to be unmeasurable.
Absolutely, yeah. I think that's one of the difficulties with this crisis is that economic forecasting is famously difficult anyway. But forecasting the political process, what decisions politicians will make, is even more difficult. So that creates a lot of extra uncertainty, of course.
Are you trying to incorporate it in your models in any way now?
Well, I mean, the big assumption that we make, and that's really the big one, is that eventually, you're going to get, from here on, we're going to see more financial stress, we're going to see more economic pain, probably we're going to see a financing crisis in Italy, and as that stress builds, we'll come to a fork in the road where politicians have to decide, well, do we want to keep the Eurozone together, yes or no? And that will really be a big decision moment. The big call we make is that, okay, eventually, when it comes down to it, the euro breakup is such a big economic catastrophe that they will say, okay, we don't like fiscal union, we don't like the idea of Eurobonds, but we have, our backs are against the wall, we have no other choice. That's of course a big call. I mean, and if they say, actually, no, let's stand aside, then the whole scenario changes.
Yeah, but do you have like some sort of state of the world? I've been taught that in finance that you have like probability Berlusconi steps out, Monti gets in. Do you have any probability stuff in your model, you as a macroeconomic? So you attach like some sort of probability, and with that you calculate the effects, possible effects?
Well, we have, we work with a main scenario, so where we actually make certain assumptions about the politics. And then what we do is that we then have an alternative scenario or scenarios based on alternative evolutions, either of the politics or of other sort of economic variables. At the moment, what we're saying is that we attach 70% probability to our main scenario, which is that we'll see a recession in Europe as things get worse, but eventually, they'll come up with the answers and that will contain the crisis. But we give a 30% probability of actually a much worse outcome, a deeper recession with sharp contractions in GDP next year, bigger than what we have already, which could start to include the beginnings of a breakup scenario. So we do it more in a sort of binary way rather than we have to have a central view for clients to say, okay, this is actually what we believe is going to happen. We don't have a kind of risk-adjusted view, but we account for the uncertainty by having an alternative scenario and attaching weights to the base case and the alternative case.
So 30%, so I could still put my money on a Eurozone in the coming 10 years.
Well, 30% for investors is quite a lot.
Yeah, it's a lot. It's really.
And our internal investment committee, which advises clients of what to do with their money, is actually seriously underweight equities on the back of our base case, which is a recession, which is not very good, and also the fact that we see 30%, which they see as high.
Yeah.
30% is quite a big. But if the politics start changing, of course,
could drop,
then this
or
is
it
maybe
could increase.
Exactly. Yeah.
Depends on
We've got a question from the audience.
In your 30% view, how long will this recession last, or how long will this growth won't be in the economy?
Well, in our base case, we're saying that the recession will last until roughly the middle of next year, and will be, not too severe. We have an output drop of around 1%. In the alternative scenario, we would say that the recession will last through next year, with an output drop of around 4%, with probably further output drops to come. I mean, if you think about a euro breakup, there's of course uncertainty like we've never known, in recent years at least, about very basic things, contracts, how our contracts are going to be denominated, about institutions, just generally about the future. You will see a string of sovereign defaults, which will lead to a banking crisis, a financial crisis, and essentially interest rates in most industrialized countries are already at close to zero. Fiscal policy, you can't have a fiscal stimulus, so in a way you don't really have the tools like we did after Lehman Brothers to dig ourselves out of the hole, up a creek without a paddle.
But no real long-term consequences, like 5 years or 10 years of low growth?
I think that we are. I mean, we're going to see long-term consequences any way you see it, because basically I think we've entered an age of austerity, where even under a favourable scenario, you're going to get year after year of fiscal retrenchment, which will weigh on growth. So, I think that it's difficult, let's say, over the next 2-3 years to really get excited about even the more favorable outcomes.
Thank you.
Okay, I study macroeconomics myself, and you studied it as well, I assume, I think. I'm wondering, you say we are entering an age of austerity. Do you still think your models of you've been taught at macroeconomics and you still use are adequate to be used in this sort of environment in these changing times?
Well, I must say that actually we don't really use any models, which is maybe a bit surprising, but we think that models are, pretty pointless actually, because essentially, and I think you are absolutely right to say, I mean, basically models are good at capturing a kind of an average experience over a long period of time.
Yeah.
They are terrible at capturing any kind of extreme event, which is usually when you actually want a model to try and calculate, okay, what's going to happen if we have this extreme event. In general, they're quite complicated. You don't really know exactly what they're assuming. So essentially, I don't know if this is a confession or not, but we don't really use big econometric models. I mean, we basically just make some assumptions about particular sectors. We use spreadsheets, of course. It's not just on a piece of paper and a pen, but we use some spreadsheets.
Just think
exactly, or in the shower, yeah. But so we make some assumptions. We compute things. We calculate. How big certain shocks will be. Try and think through the
possible scenarios.
Scenarios and knock-on effects and so on. But we don't, have a big ABN Amro model which we just press a button and it comes up with all sorts of numbers, because we think, we've used models in the past, and our basic view on them is that they're not really worth much.
Where did that change? Like you used them in the past and now you don't use them anymore?
Well, I think I would say that we never really used them as the only sort of tool in our toolbox, but we've used them before as a sort of a backup mechanism. For instance, if the oil price rises by $30, what does it do for the economy and so on and so forth? And we found basically that they have variable effects. We've used them intermittently, but at the moment we are not users of any kind of big whole economy econometric model.
But could you say that they lost significance during the last 3 years? Maybe could you?
That's also true. That's also true. I think that's a perfect example of where econometric models are not really very helpful. I think no. We have people. I'm not going to mention names of these companies, but we have people who come to try and sell us econometric models, from all over the place, and then they show us, and it all looks very impressive. And then if you ask the question, okay, what did your model predict in 2008, 2009? Did you capture this? Oh no, we didn't capture that. And then you think, well, okay, I don't really, people don't really care whether growth is 1.5 or 2 or 2.5,
no.
Which is probably where these models perform okay-ish.
Yeah.
People care, okay, is there a big recession coming? Is there a big boom coming? And in those sort of extremes, these econometric models tend to fall short. And I'm not saying that, my own personal, judgment and so on, is also a perfect indicator, but at least people can actually think through things, understand the assumptions they're making. We just think it's better.
What really surprises me is the political party PVV. I'm not sure if you've heard about it.
It's a Freedom Party.
Oh, the Freedom Party. Yeah, of course.
They,
yeah. No, I know everything about that. Yeah.
But they think the gulden or old currency needs to come back, and they have outsourced the investigation to Lombard Street Research.
Yeah.
And they've already showed in the media that they are also, or they think the euro is a big fail and countries should move back to their old currency. What really surprises me is that they at least claim to be experts, and a lot of other macroeconomics also claim to be experts, but their opinion about what we should do is like completely opposite. Yeah. What parts of the interpretation in these models are open for different opinions?
Well, it's all about assumptions, of course. I mean, basically, that's another thing with these models. I mean, what you put in is what you get out. So, they probably different people put in different things. It strikes me as, that's a typical ploy. If you want to get a certain answer, you choose your consultant or your economist, of course. And there are different opinions. I must say that many years ago I worked at the Ministry of Finance in the UK, and then at the time the UK government had a policy of that they would go into the euro, but only if the economic conditions were right. And there we did sort of all kinds of tests and carrying out all kinds of tests, and there the decision was made that it wasn't a good time to go into the euro. And I can imagine that you get to that conclusion, if your starting point is unfavourable, like it was for the UK. They had a very strong currency, they had higher interest rates than in Europe, and if you had to pull down the currency and pull down the interest rates at the same time, you would cause quite a big economic boom, which would probably be difficult to control. And I think that's what happened to Ireland and Spain and some other countries. But the point is that going in is a different issue than actually a euro breakup.
Yeah.
You have to consider the starting point. And for me, breaking up the euro would almost certainly be an economic catastrophe, which would probably see big cumulative losses in output, in wealth, and in people's livelihood. So
they probably don't take account for that meltdown that
well,
will rise.
I'm not too sure. I'm not too sure, but I've heard. I mean, I don't know the person personally, but I have heard that he is a Eurosceptic.
Mm-hmm.
Yeah.
So, I mean, what answer do you think he's going to give? I mean, it's pretty obvious, isn't it?
How damaging is that for a country like Holland? Like a political party asked for such an inquiry. Was it in any way damaging, or?
Well, I mean, I think it's good to have a debate. I think, that, again, it's a personal view. I mean, I think it's always good to have a debate about these issues, but, it should be, of course, a debate with, good information, with people putting forward the different sides of the argument. And, often with these kind of debates, it's the people with one kind of simple populist message who are in the forefront, and there's other politicians who are a bit scared to get involved with what might be an unpopular message, and you wonder whether I don't want to get too much into Dutch politics, but just generally European-wide, whether you're having a balanced debate now, or whether you're having any kind of debate. I think we need to have a debate.
Yeah. But because I also saw in the newspaper a couple of days ago that the spreads between Dutch interest yields and the German interest yields were widening.
Yeah.
I thought maybe that could be explained by such an inquiry, stuff like that. What's the explanation for that, do you think?
Well, I mean, during this crisis, generally, countries like the Netherlands, Finland, and Austria have tended to be safe havens, along with Germany. So when people were worried about the euro, they would move, their money into these countries. And then last week, for the first time, we saw that Austria, Finland, the Netherlands selling off as well. So not necessarily a Dutch-specific thing.
No.
But it was indeed very important that everyone, all bonds were selling off apart from Germany.
Yeah.
And essentially, that's the kind of play which you would associate with people being worried about a euro breakup.
Yeah.
So.
And because the German market is more liquid than the Dutch market, in a way, because we're very similar to Germany, I think.
Absolutely. I mean, in terms of public finance fundamentals, I think the Netherlands is at least the same quality as Germany, but indeed Germany has the sort of liquidity going for it.
Yeah, because they're larger.
Yeah, exactly. And of course, I mean that, the country which really has the liquidity going for it is the US, and that's maybe the big argument for a euro bond market is this kind of liquidity, because that's what investors like.
Comes
basically
down to liquidity again, actually. Yeah. We have another question.
I was wondering, as these bonds are not that popular and the stock market isn't doing as good as well, as an economist, what do you advise to funds who want to invest some money?
Okay.
Is that the stock market? Is it bonds, or is it like other investments that you advise them to make?
Well, I should be careful here because I'm just a humble economist, and I'm not really qualified to give people investment advice, and especially not, sort of like in an impersonal
More another
way.
question: what's a safe haven?
Yeah. Okay. Well, it depends what you're running away from, but what they say is, okay, if you think there's going to be a full European breakup, then maybe you should take a gold and gun scenario, which means that you take some gold, dig a hole, put the gold in it, and then use your gun to defend yourself. That's of course just a joke. But it just, basically in a euro breakup scenario, if you need to hold euro assets, it's very difficult to get away from it. You want to be away from euro assets, basically. But if you are an investor who is actually based in Europe, which has obligations in euros, it's very difficult, of course. So, obviously, in that kind of scenario, there are very few safe havens.
Would it be a time to make companies more efficient instead of like spending money on new investments?
Well, that's something that you see already. That's something. In a downturn, we've of course had the downturn of 2008-9. We're now, I believe, entering a new recession. That tends to put pressure on companies to streamline and improve their profitability. One thing about companies throughout Europe is that they are incredibly cash rich at the moment. The cash that companies hold relative to the country's GDP has never been higher. So that tells you something about also caution. They have a lot of cash. Actually, they don't really need that much financing. They have their own cash to finance investment, but of course, because of the environment, they don't want to invest. So, that's of course, a shame for any economy, but that's the way it is. I guess it's prudent for them to behave like that now.
And further on, what does ABN AMRO do with the money it has right now? Is it because it withdraws all its money from government bonds? Is it like in the stock market, or are you further looking for new houses? Or
we have we have an investment committee which basically is not about the asset and liability management of the bank. That's something which is internal, and but we have an
strategy.
We have an investment committee which suggests an investment strategy we manage money for clients, but we also give investment advice to other clients. And essentially, we are now heavily underweight equities, so we have a very cautious view because we think the economy is entering a recession. First of all, the European economy. So we're also underweight, even more underweight European equities, but also because we see that there's a big chance of a risk scenario which could eventually be catastrophic. So we think that in that kind of circumstance, it's good to have a lot of cash and less equities. Yeah. And if we see the politics changing, then perhaps then you have the cash and you can look for new opportunities.
Those liquid bonds aren't that bad at all.
It's all relative.
As long as they're North European safe havens.
It's all relative, I think, and we've said that in the realm of companies, that the companies that we like are companies which are cash rich and have a steady cash flow, basically. because they are, in a way, in some way, some companies are safer than governments now.
So we can conclude we're all waiting for politicians to intervene and to get that crisis scenario out of the clouds, actually, I think. Let's focus a bit on ABN AMRO. They reported, I think it was Friday, a loss of 53 million. And I've heard Gerrit Zalm, the CEO, speaking about, because he was finance minister during the 90s and he already foresee some Greek problems arising, that ABN AMRO sold all the Greek bonds. Still, you reported quite a big loss compared to last year. Did it come due to other obligations, other bonds in the Eurozone, or where did it come from?
Well, I think Gerrit Zalm, has announced this in the quarterly earnings report. That came from corporate bonds, Greek corporate bonds, which were government guaranteed.
So they were linked with the turmoil.
Sure. Yes. Yeah.
And how much is ABN exposed to Mediterranean bonds?
Well, this information is publicly available, so we publish it. But well, first of all, I don't know it off the top of my head. But also, I think that I'm not really, I'm again a humble economist. I'm not really able to speak on behalf of the company and its earnings. So. I try to be as open as possible, but that's
there are boundaries.
There are boundaries, yeah. So, but this information, I think, if you look through the quarterly earnings report, I think ABN AMRO does, is transparent on these issues, and there is also the European-wide stress tests, which also provide a lot of information about all the big banks in Europe and their exposures to different peripheral bonds.
Yes. Are there any more questions in the audience? No. Okay, well then I have one last question. 9 December, we have another Euro Summit. Do you expect any repetition of the summit we had in 27th of October? Is it like heavy expectations, no result?
Well, we've had 3 summits so far this year, which were the final. Each of them was billed as the final summit to save the euro. I think I must say that there is little information about moving up to December what might happen. Given where we are now, I don't have huge expectations already for that summit. But I think as I've said before, we will have a summit sometime soon, probably an emergency summit. Maybe it will be in 2012, where we will get actions, because without them, there could be very dire consequences. I think we are we're probably not completely there yet, but we are approaching the end of what they call muddling through.
Yeah.
It's either now sink or swim.
Yeah,
that's good.
Two options.
Well, I want to thank you for visiting us. I think you've been really open, and I, at least, really liked the interview. Next week, the 29th of November, Sander van der Laan will be our next guest. Then the day after, 2 days after, the 1st of December,
Thursday.
Okay, at 7 p.m., I believe.
Yeah.
We have a session about, what's the subject?
A panel discussion about the guilty ones of the crisis. We have Ewald Engelen, Matthijs Bouwman, Peter Verhaar. We're going to do a bit of role-playing. We have the banker, we have the toezichthouder, how do you say that? The supervision guy. And it's going to be nice as well. And in the new season, in February, the 6th of February, we have Klaas Knot, the Dutch central president. And we are looking for new committee members as well, for new interviewers. So if you want to join here, send us an email. Give a warm applause to Nick Kounis.
Thank you.